Smart Silver Stacker here. Hope you're doing well. We need to talk because another U.S. bank just failed. And that's the headline story today. When you examine the backdrop against which this is occurring, it seems very unlikely, from my point of view, that this is going to be the last bank to fail. So let's get right into it and let's talk about what kind of implications this bank failure is going to have for the price of gold and the price of silver. So this headline hit Friday after markets closed. Very interesting, of course. That always seems to be when these big events take place. And this was certainly at a time and place of the FDIC's choosing. Regulators close Philadelphia-based Republic First Bank, first U.S. bank failure this year. That's the headline. And so on Friday, following the close of markets, the FDIC announced that it had seized the Philadelphia-based bank, which did business as Republic Bank, and had roughly $6 billion in assets and $4 billion in deposits as of January 31st. So before we go any further, I think it is important to note this is a relatively small bank. That's not a huge amount of assets or deposits. So, we're not seeing some economy-altering event here. However, these smaller banks, a large number of which are basically insolvent at this point, I think they are a bellwether for us, a canary in the coal mine, so to speak, of what may be coming for the regional banking system in the United States as a whole as we move forward. Also, this is an important note. We'll talk about this in just a moment, but Fulton Bank, based in Lancaster, Pennsylvania, agreed to assume substantially all of the failed bank's deposits and buy essentially all of its assets, according to the FDIC. All right. So do you remember what happened to the premiums on gold and silver in March of 2023? I mean, that is really why this is germane to the topic of stacking in the first place. Threats of insolvency in the banking system, the cracks starting to show, can drive a huge number of investors, the smart money, I would say, into the safe haven of physical gold and silver. If you remember when SVB was failing last year, we saw a huge soaring interest in physical metals, specifically physical metals, right? Not the SLV, not the GLD. It was physical metal that was getting bought up by investors as they were looking for somewhere to get their money out of the banking system. But you got to understand, if the banks start to fail, the paper gold and silver are not going to be the safe havens that they are touted as, at least not the derivatives like the futures markets and the ETF. I mean, maybe the miners might do okay. We'll see. But physical metals you definitely need to have in the event of such a crisis. And we're going to look at some numbers here which show exactly why this is very likely not the last bank to fail in 2024. And also, I will say, you should temper the reaction to this news with the knowledge that it's not that unusual for banks in the United States to fail. I mean, they fail pretty consistently. Smaller banks like this, under normal circumstances, I would say this wouldn't really be too much to worry investors, but this is hardly normal circumstances. And I'll tell you exactly what I mean in just a moment. First of all, if you do want to get some physical metals to shelter yourself from the potential fallout of a massive regional banking crisis, the likes of which will likely force the Federal Reserve to print huge sums of money, head over to sdbullion.com, today's video sponsor. You can get physical metals over there. It's right by mine. Premium's still relatively low. Right now they got Canadian maple leaves, $279 over spot. That's going to seem like a darn good deal if this banking crisis worsens. So let's take a look at this. This is in large part why these banks are facing disaster. At least this is part of the equation, right? This is the interest rate on a 10-year U.S. Treasury bond. And you can see that as of Friday, this number has risen to 4.66%. It actually touched over 4.7% on Friday's trading session. Now, this is critically important because one of the reasons that these banks are coming under so much pressure is because they're sitting on huge piles of US treasuries. When I say piles, that's a figurative term. These are all just digital assets, but they're sitting on US treasuries that have a very low yield compared to today's yield of 4.7%. Now, that means that those bonds that they're sitting on have devalued significantly. Now, the way that the banks get around this is on their balance sheet, they mark these assets as a hold to maturity. So with bonds, you got to understand how this works. You buy a bond at a given interest rate. Okay, say it's 0% or 0.5%, the kind of bonds that these banks were loading up on during the pandemic and the huge spate of government borrowing and debt issuance that occurred at that time. Well, now that bonds are yielding 4.7%, obviously the bond with 0.5% is not worth the same. However, if you hold it to maturity, so say it's a 10-year bond, if you hold it the full 10 years, you're going to get your face value back. But if for whatever reason you're forced to unload that bond before maturity is reached, say depositors start pulling their funds out of your bank and you've got to give them their money. So how do you get it? You've got to sell some of your assets. Well, that's when they're forced to take a loss, right? And that's what happened last year with SVB. Well, one thing you'll notice is we can pull up the 1-year chart here, and this obviously doesn't go back to March because we're towards the end of April here, but it serves the purpose. You can see that a year ago, the yield on 10-year treasuries was far lower than it is today. It was in the range of 3.5% or so. And yet at that level, these banks' losses, as they were forced to sell some of those bonds, they were taking huge losses. So you got to understand that those losses are that much greater now that yields have risen more. So if the banks are forced to sell those assets at today's valuations, if they force to mark them to market, a lot of these banks are actually insolvent, meaning they don't have enough money to make good on all of the deposits that they have promised to depositors. So, that's a huge problem. Another problem is the massive devaluation of commercial real estate. Now, you also have to understand that all of this is due to the Fed hiking rates. The problem is the Fed has hiked rates to the current level, federal funds rate, 5.25% to 5.5% to fight inflation. But inflation is still rising. Now, the only way the Fed can solve this problem for the banks is to cut rates or to get back into the market and to begin buying US treasuries to drive the yield down, right? And the same goes for the commercial real estate space. This is a headline from the New York Post from April 25th. Famed Monty Tower that inspired hit song sells for a lot less cash than it fetched a decade ago in troubling sign for New York City market. Now, this gives you an idea of why the banks are in so much trouble. So the banks have on their balance sheet a lot of assets, a lot of loans that are backed up by commercial real estate. However, the problem is that the commercial real estate now isn't worth what it says it is on paper. So it's kind of the same story with the bonds. As interest rates have risen, it has driven the value of these assets down. If interest rates and mortgages are higher on commercial mortgages, then you're going to have to devalue the property because there won't be as many buyers. If you can't borrow money as easily to pump it into this market, the valuation of the properties declines. Now, this specific tower gives you an idea of just how bad some of these commercial real estate properties have devalued in this environment of higher interest rates. And it's not just higher interest rates, it's also lack of occupancy. So it's kind of a perfect storm for commercial real estate because interest rates have gone up, so it's harder to buy them, harder to borrow money to buy these properties, but also following the pandemic, the shift to people working remotely, etc., there's a lot less occupancy. In a lot of these buildings, you need like 90% occupancy in order for them to be cash flow positive. And many of these properties are experiencing vacancy rates far higher than 10%. So Yellowstone Real Estate bought this tower for $185 million recently. That is a $420 million haircut from how much the tower fetched a decade ago. It was Blackstone bought the tower for $605 million back in 2014. So they bought this tower for $605 million and they just sold it for $185 million. And that gives you an idea, if the banks are sitting on a loan for a property and the loan assumes that the property is valued at $600 some million and the property is actually only worth 185 million. Well, the collateral that backs up that loan isn't worth what the loan is, right? So it's going to mean huge losses for the banks. I see in the chat, I've kind of been keeping an eye on it. A lot of people are talking about Goldbacks. I mean, I know, a trigger warning, folks. There's Goldbacks on the desk in the video here. Let's just put it this way. If the banks fail and the Fed has to monetize all the losses, Goldbacks are going to be a good thing to have. And people talk about how, oh, this and that coin shop won't take it. Well, it doesn't really matter if this and that coin shop doesn't take it as long as there are dealers that will accept Goldbacks. And the same goes for any bullion, right? Like, I'm going to just do a quick tangent here about the Goldbacks and about, selling your bullion. Listen, if a 10-ounce gold bar, if, this thing, what is today, the spot price is 27 bucks, so this should be fetching maybe 270 bucks, 280 bucks. If I take it down to the pawn shop down the street and they say, well, I'll give you 50 bucks for it, that doesn't mean that it's not good to have in your stack, right? It just means don't deal with that pawn shop. This is something that people seem to not understand about markets. Like, as long as there is a buyer and guaranteed, I mean, it's so easy to see that people will pay what Goldbacks are worth. Just go to eBay, look at completed auctions. You'll see that many of them are selling for more than what online dealers like SD Bullion will sell them for example. And so, I mean, look, the proof's in the pudding. It's undeniable that there is a market to get rid of your Goldbacks. And look, Goldbacks aren't really, to me, for stacking up to sell later for a profit. I mean, you could do that, certainly. The Goldbacks that I've purchased, they're worth way more now than when I bought them, with gold knocking at record all-time highs. But Goldbacks are like an emergency barter currency. Or if you like sound money, I mean, you can go try and use them now, especially if you live in one of the states where those exist. If you're not familiar with Goldbacks, go check out goldback.com or look at some of the other videos I've discussed on them. I mean, they're very controversial. Trigger warning, there's Goldbacks. Everybody freaks out when you see Goldbacks. But anyway, enough about that. Goldbacks, I think, suffice to say, will be a good thing to have if the U.S. banking system fails, as well as physical gold and silver. I mean, any type, right? And yes, you can get physical gold out of them. Now, if you take one Goldback, that's only 1/1000th of an ounce of gold. It's going to be very difficult without some kind of highly sensitive material to measure that amount of gold. But if you take a nice stack of them like this, like 100 Goldbacks, and you melt it down, you're going to get 1/10 of an ounce, guaranteed. There's evidence of this. I mean, there's people who have done it live on YouTube. Now, there are also people who have melted down one Goldback and said, oh, I didn't get any gold out of it. Yeah, that's because you're not using sensitive enough material, because that's such a tiny amount. Someone says, what can Goldbacks do for you that fractional silver can't? See, I knew that this was a trigger warning topic here. The chat just explodes when you mention them. Well, I mean, first of all, they're made of gold. So, if you want highly fractional gold instead of highly fractional silver, then these are a good thing to get. I mean, do I really need to spell out for you what the difference is between gold and silver? Like, they're elementally different metals. Anyway, and, you've kind of seen that with the price performance. To be fair, Goldbacks have outperformed silver recently, with gold outperforming silver. So, look, I mean, I love silver. I love Goldbacks. I love gold. I'm not like on a team here, but for those who exclusively stack silver and then poo-poo Goldbacks, well, Goldbacks have outperformed your silver. So, proof's in the pudding again. You just look at the numbers. But anyway, let's get back to the topic of banks, shall we? I'm sure that there are those who are not interested in Goldbacks in this live stream. And do me a favor, by the way, we got 280 people in the live stream. Smash that like button. Only 49 likes so far. Let's help get this information about the banks and Goldbacks out there. So this is the chart for New York Community Bank Corp. I'm trying to get the chart to load here, but this is an important one to examine because this shows you exactly what can happen to a bank in the event of significant hit on their commercial real estate portfolio. And I think that chart really just says it all. They announced that they had lost some, I think $2.5 billion or something like that in bad CRE loans they had to write off because the properties weren't worth what they said they were on paper. The price absolutely crashed. The share price of this regional bank that has a huge amount of CRE exposure. Now, they got kind of a de facto Goldback bailout. Reading the chat as I talk here. They got kind of a de facto bailout by a group of investors who pumped some billions of dollars into this bank. That was a group of investors led by Steve Mnuchin, a former Secretary of the Treasury, by the way. So, I mean, if that's not a little odd, I don't know what is. I mean, it's a game of inside baseball. It's a big club and you're not in it, so to speak. And when they have billionaire former secretaries of the Treasury coming in here to bail out these banks as an investor. I mean, you know what's going on here, right? They're trying to instill confidence in a system that really isn't worth that confidence. I mean, that's just the bottom line, right? They've set things up here by keeping interest rates artificially low for over a decade, keeping rates near 0%, creating a huge bubble in commercial real estate, and then hiking rates to fight the inflation. I mean, this is like central banking mismanagement 101. And now they're going to find some kind of a scapegoat for this. I don't know who it will be or what it will be, but guaranteed there's a crisis here. And when a crisis plays out and they say, "Oh, who could have seen this coming?" I mean, just go back to this channel and watch the old videos in the banking system, and you'll know who could have seen it coming. Myself and all the stackers who were paying attention, right? I mean, I'm far from the only person who has sounded the alarm on this, but nonetheless, we're going to get a crisis here at some point. And you'll probably come back to this video in a year or 6 months, and it's going to be like, oh yeah, I mean, who wouldn't have seen this coming, right? But they're going to act like it's a big surprise when the banks fail, and then they'll say, what choice do we have but to print huge sums of money? Because here's the problem: the FDIC. I mean, the FDIC covers the deposits in these banks, right? But the FDIC doesn't have enough money to cover all of the deposits in these regional banks. It's kind of a dirty secret, right? They do have some money. It's in a fund that they fill by charging fees to participatory banks, and it doesn't cover all of the insured deposits, not by a long shot. I mean, the deposits that are in risk here far exceed what the FDIC has, and so how are they going to make good on that insurance if this thing falls apart? Well, I mean, simple answer: they print the money, right? That's the bottom line. Not to mention the uninsured deposits. A lot of these banks have deposits in excess of the $250,000 FDIC limit. Now, they might make good on those deposits. That means they'll have to print a lot more. But at the end of the day, the FDIC insurance really isn't a guarantee of anything, because it's either you let the investors who were in the troubled banks, or the depositors, not the investors, but the depositors, lose their deposits, or you print all the money to make good on them and you devalue everybody's currency, right? So it's like you either have a concentrated group of people take the loss, or you disperse it among the entire monetary system. And I mean, we know what they're going to do, right? They're going to devalue the currency, very likely. There's other problems for these banks as well. I mean, you got the Bank Term Funding Program, this thing right here. This is a mechanism that was created last year during the financial crisis, during the banking crisis, to help alleviate some of the stress that these banks were coming under from the elevated interest rates on U.S. Treasuries. What this facility allowed the banks to do was put up those low-yielding treasuries as collateral with the Federal Reserve, get a loan based on their face value, their par value, so more than they're actually worth. But this just ended, right? It ended here. It's coming back down. They're unwinding these loans. And so the banks not only are coming under pressure from interest rates that are higher than they were a year ago, and heading higher as inflation continues to creep up. Yields have to rise unless the Fed gets involved. Of course, the problem is there. If inflation is what is driving yields higher, and then the Fed acts by printing money to drive yields down, you can see how this can become a pretty big problem for inflation, and how the central bank finally, excuse me, can get backed into a corner where the only option is either allowing a systemic collapse or devaluing the currency massively. Now, in either situation, you're going to want some physical metals. I mean, especially the hyperinflation, debt destruction, currency crisis scenario. But even if there's just a massive deflationary crisis, I think that the metals will definitely be somewhere to keep wealth outside of the banking system. That's really the key here. And also, you'll notice that even though the Bank Term Funding Program has been winding down, it's wound down from a peak of about $167 billion down to 125. It's still got a long way to go. And, supposedly this program, these loans have a term of about 1 year. So by March, April of next year, they're supposed to unwind all of these. Well, how are they going to do that as commercial real estate continues to devalue and yields continue to rise, putting pressure on these banks? Well, now they're told that they have to pay back those loans. A lot of them probably don't have the money, because why were they taking the loan out in the first place? It was to make good to their depositors, right? So now what they're going to do is they're going to get back the devalued loans that they put up for collateral. How do they even have the cash to give to the Fed to get their collateral back? I mean, the Fed is going to probably end up eating a lot of these loans. I mean, that's my guess. Or again, they're going to risk a collapse of the financial system. And we are starting to witness that. This is important because we're at April 28th now, and we just saw the first bank to fail. Now, think about this. When did the bank fail? I mean, the bank got seized on a Friday afternoon, immediately following the close of trading. Why did they choose that time? It's because imagine if they did this on like Friday morning, right? As trading was going on. I mean, I think it would have been a very different day for gold and silver if they had done that, and a very different day for many of these other commercial, these real estate, or I'm sorry, I'm conflating words here. These regional banks, that happens sometimes as I try to read the chat. I start, saying the words I'm reading. Anyway, it's not looking good, folks. Again, this is not a guarantee of a systemic crisis kicking off just yet. This is a relatively small bank. However, the fact that we just saw the first bank of 2024 to fail, I think, is important as we head into a deflationary or a stagflationary scenario. We just got the GDP numbers that were lower than they were expected. We got the core PCE numbers were higher, so that is inflation beginning to tick up once again. And that's going to be a very difficult scenario for the Federal Reserve to get in there and solve these problems for the banks. But it's a very good environment to have precious metals. I mean, it's just about the best scenario you could think of for the price of the metals. Now, I think that as stackers, we don't need to hope for this stuff. We'd probably all still be better off if the banking system doesn't collapse and the currency doesn't get massively devalued. And yet, at the same time, I think it would be foolish to assume that everything will be okay just because we want it to be, right? So look, now is a good time to be stacking. I know that the metals have been on the rise. We had silver last Friday, the highest weekly close in 13 years, or 11 years, the highest in over a decade, and since 2013. Highest weekly close. We've got gold knocking at all-time highs. However, this past week, we saw a little bit of a pullback in the price of the metal. So now is a good time to buy, if you ask me. When you see new all-time highs getting taken out, you might have pause and think, well, maybe I'll wait for the pullback. Well, it's here. I mean, silver is now under 28 bucks. Gold back in the 2,300 range and probably heading much higher. And now, especially the physical metal, because let's say the banks start to fail again. You might not see a huge move in the spot price of the metals. I think that they are moving higher, and I think there will be a move into them. But the move in the price of physical metal, and we refer to that as premiums, the amount that physical metal costs over the spot price, that is going to be moving up even faster than the spot price. And this is the kind of scenario where it really holds true. If you don't hold it, you don't own it. Now, I talk about gold companies and things like that on the channel, and I do think that there's potential to get significant gains there as well. And I have exposure to the mining sector and other gold and silver companies as well. I think those are good, but it would be a mistake to own those to the exclusion of physical metal. And this stuff is really the core position. And this stuff, if the crisis really reaches a head and it massively expands in short order, this stuff is going to be what performs the best, I think. If we see kind of a slow, orderly depreciation of the dollar and a rise in the spot price, there might be some other things that outperform the physical, but the physical is so important to hold because you got to understand this is the stuff without counterparty risk. This is the stuff where there's no way that you wake up in the morning and you find out, oh, your gold and silver have been bailed in, right? It's not possible, right? It's in your physical custody. Only way to get it is to physically take it from you. And that's a lot harder than just bailing in a digital deposit somewhere or, forcing the sale of a futures contract, settling some kind of digital asset in fiat currency that's been devalued. Can't do that with physical metal. Now, a lot of times people will say, well, they'll just ban the ownership of physical metal. I mean, yeah, anything can happen, right? There's always like an answer to any preparation. But one thing, they've never, ever in the history of the United States banned the physical ownership of gold. I'm sorry, silver. They have banned the ownership of gold before via executive order under FDR, but silver has never been confiscated. Doesn't mean it won't be, but silver is a lot safer in that regard. And look, the logistics of a confiscation of physical metal, pretty difficult. I mean, honestly, there's the old joke, I lost it in a boating accident, but seriously, like if you have physical metal, let's say it legitimately gets lost or stolen and they come to confiscate it, well, what are you going to do? I mean, you say, I don't have it, right? And because you don't. And in that scenario, I mean, how do they prove that one way or the other? I mean, I don't know. The logistics of a confiscation, and I'm not suggesting anybody do anything to violate any, decree or whatever regarding their metals, certainly not. Um, Yet the idea of a confiscation of physical metal, I think, is kind of far-fetched. And look, I mean, the likelihood of a financial crisis, to me, my view, not financial advice, not telling anybody what to do, but to me it seems almost guaranteed with the way the numbers are stacking up. Massive deficits, massive debts, huge inflation in the pipeline from all the money that's been created and is about to be created, banks that are largely insolvent and they're using tricks of accounting to make it appear as if they are not underwater. Like in that scenario, the likelihood of a crisis is very high, whereas the likelihood of all these problems you can come up with, oh, don't stack metals because of confiscation. Well, look, your fiat wealth is being confiscated daily by devaluation, and I mean, they don't even make a secret of that, right? The Fed tells you their inflation target is 2%. Now they're doing a lot better than that lately, but the target, the objective is to devalue the fiat currency by 2% annually. So think about that, right? I mean, it kind of makes you want to have some physical metal, whether it be Goldbacks or bars or coins or whatever. I mean, just something that you can hold in your hand. It's important not to get too hung up, I think, on the varieties of metal. I stack a lot of different stuff. I think diversification is a good way to go, and I will stick to that. But let me know what you think about that in the comments down below and all these stories that we covered today. Also, do me a favor, smash that like button, subscribe to the channel, and if you got Twitter or other social media, share this video. And if you're on Twitter or X now, I guess it's called, give me a follow at Stack Smarter. I've been trying to get more active on there, and the comments on these videos are great. I do read the vast majority of them. But if you really want to engage me in dialogue, hitting me up on X is a good way to do that, at Stack Smarter. I'm probably more likely to engage in a more conversational way if you hit me up there, but still leave a comment. So anyway, thanks for watching, everybody. Leave me a comment down below to let me know what you think about everything we covered today, and I will catch you next time. It's going to be a very interesting week for sure, and interesting remainder of this year, especially leading up to this election. A lot of things we need to keep an eye on, including banks failing. So thanks for watching, everybody. Stay safe and happy stacking. I'll catch you next time. Smart Silver Stacker, out.